Section 1. The Big S-Corp Myth. A promise of clarity for 2025. Many new business owners hear a very tempting myth. It goes like this: you must become an S-Corp right away, because it will always save you thousands of dollars in taxes. This idea sounds wonderful, especially when you are just starting out and every dollar counts. People share this advice with good intentions, hoping to help you keep more of the money you earn. They might tell you stories of friends who saved a lot of money, making the S-Corp seem like a magic key to lower taxes. This single piece of advice is repeated so often that many entrepreneurs believe it's a universal truth for every business, no matter its size or profit. The reality, however, is much more complex, and this myth can sometimes lead you down the wrong path. The truth is that an S-Corp does not always save you money. In fact, for many small businesses, especially those with lower profits, choosing to be taxed as an S-Corp can actually cost more than it saves. The potential tax savings can be completely wiped out by new costs and extra administrative work that come with the S-Corp election. Making the wrong choice based on this myth can lead to unnecessary expenses, headaches, and even trouble with the IRS if rules are not followed correctly. This guide is here to give you the clear answers you need for 2025. Section 2. What is an LLC? What is an S-Corp? The simple truth. First, let's talk about what an LLC really is. The letters LLC stand for Limited Liability Company. Think of an LLC as a legal box or a protective shield you put around your business. Its main job is to separate your business activities from your personal life. This means that if your business were to face a lawsuit or have debts, your personal assets, your house, your car, your personal savings, are generally protected. It is a legal structure that you create at the state level, and it is known for being relatively simple and flexible to set up and maintain compared to a traditional corporation. An LLC is very flexible when it comes to taxes. This is a key point that many people misunderstand. By default, the IRS treats a single-owner LLC just like a sole proprietorship. This means all the business profit passes through to your personal tax return and you report it there. If an LLC has 2 or more owners, the IRS treats it like a partnership by default. But here's the important part. An LLC can choose how it wants to be taxed. It can tell the IRS, please tax me like an S-Corp. This means the debate is often not LLC versus S-Corp, but rather whether your LLC should stick with its default tax status or elect to be taxed as an S-Corp. Section 3. The Tax Showdown. Self-employment tax versus payroll tax. The main reason anyone considers an S-Corp is to save money on one specific tax: self-employment tax. If your business is an LLC taxed as a sole proprietorship, all of your net profit is subject to this tax. Self-employment tax is how the government collects Social Security Medicare taxes from people who work for themselves. For 2025, this tax is a hefty 15.3% on the first portion of your income, up to the annual Social Security wage-based limit, $177,000 for 2025, then 2.9% Medicare applies on profit above that. This is a significant cost on top of your regular income tax. The S-Corp changes how this works. When you have an S-Corp, you must pay yourself a reasonable salary as an employee of your own company. This salary is subject to payroll taxes, split between the employer, your company, and the employee, you. The total is still about 15.3% on wages up to the Social Security limit. However, any profit left over in the business after you have paid your salary can be taken as a distribution. Section 4. The Math. How S-Corp and LLCs stack up at 3 profit levels. Let's look at some simple math to see when an S-Corp might save you money. We will examine 3 different business owners, each with a different level of profit. These are simplified examples for 2025, and your actual situation will be different. It is always best to consult with a tax professional. We will assume the S-Corp has extra annual costs of about $2,500 for payroll services and more complex tax filing. First, let's consider a business with a $40,000 profit. As a default LLC, you would pay self-employment tax on almost all of this profit, about 92.35% of it. The self-employment tax would be roughly $5,652, 15.3%, on $36,940. Now, if you choose to be an S-Corp, you must set a reasonable salary. For this level of profit, a fair salary might be around $30,000. Your company would pay payroll tax on this salary, and the profit distribution would only be $10,000. The potential tax savings would be on that $10,000 distribution, which amounts to about $1,530. However, after you subtract the $2,500 in extra administrative costs, you are actually losing about $970. In this case, the LLC is the clear winner. Next, let's look at a business with a $100,000 profit. As a default LLC, the self-employment tax would be approximately $14,130. Now let's see what happens with an S-Corp. Let's say a reasonable salary for the work you do is $60,000. The remaining $40,000 of profit can be taken as a distribution. The self-employment tax savings would apply to this $40,000 portion. The saving is 15.3% of $40,000, which equals $6,120. Now we subtract the estimated $2,500 in extra S-Corp costs. Your net savings would be around $3,620 per year. At this profit level, the S-Corp election starts to make good financial sense, as the tax savings are significant enough to easily overcome the added costs. Finally, let's consider a business with a $200,000 profit. At this high profit level, the S-Corp is almost always the better choice, with potential net savings of nearly $10,000 a year. Section 5, the 20% pass-through deduction QBI, a simple guide for 2025. There is another important tax break for small businesses called the qualified business income, the QBI deduction. This is also sometimes called the pass-through deduction or Section 199A deduction. In simple terms, it allows many owners of pass-through businesses, which includes default LLCs and S-Corp, to deduct up to 20% of their qualified business income from their taxable income. This is a very valuable deduction because it directly lowers the amount of income you pay income tax on. It is important to remember that the QBI deduction reduces your income tax, but it does not reduce your self-employment tax. For many business owners, both the default LLC and the S-Corp structure can qualify for the QBI deduction, so at lower income levels it might not be a deciding factor. If your taxable income is below a certain threshold, around $194,050 for single filers in 2025, you can typically take the full 20% deduction without complex limitations. For example, if your business has $100,000 in profit, the QBI deduction could be up to $20,000, which means you would only pay income tax on $80,000 of that profit. At higher income levels, the S-Corp can have a distinct advantage because it creates W-2 wages that can help unlock larger QBI deductions. Section 6, the hidden costs, when S-Corp savings disappear. While the potential tax savings from an S-Corp can be very attractive, it is crucial to look at the other side of the coin. The extra costs and responsibilities can completely cancel out those savings, especially for lower profit businesses. The first and most unavoidable cost is payroll. Once you're an S-Corp, you become an employee, which means you must run formal payroll. This requires subscribing to a payroll service, often $50 $120 plus per month. The payroll service will calculate your withholdings, pay your taxes, and generate your pay stubs. On top of that monthly fee, running an S-Corp requires more complex tax filing. Instead of only reporting income on your personal return, your business must file a separate informational return, Form 1120-S. Preparing that return is more complicated and time-consuming, so your CPA will likely charge more. Tax prep fees commonly run $800, $2,000 higher for an S-Corp, depending on business complexity and bookkeeping quality. Also check for additional state fees. A conservative estimate, $2,000, $3,500 extra per year. If your projected tax savings are less than that, S-Corp election likely isn't worth it financially. Section 7, S-Corp versus LLC myths, busted with simple facts. Myths about business structures and taxes can spread quickly, leading to confusion and poor decisions. Let's bust a few of the most common myths with simple, direct facts, so you can see the truth clearly. Myth: an S-Corp will always save me money on taxes. Truth: an S-Corp only saves money when your profit is high enough for the tax savings to be greater than the extra administrative costs. Myth: I can pay myself a $1 salary in my S-Corp to maximize my tax savings. Truth: no, the IRS requires you to pay yourself a reasonable salary based on market rates for your job, and setting it too low is a major audit risk. Myth: LLCs are bad for taxes because you pay self-employment tax on everything. Truth: LLCs are simple and cost-effective at lower profit levels, and they can still benefit from many valuable deductions, including the 20% QBI deduction. Myth: choosing an S-Corp gives you better legal protection than an LLC. Truth: the S-Corp is a tax status, not a legal entity. Your legal protection comes from your underlying LLC or corporation structure. Myth: once I choose to be an S-Corp, I am stuck with it forever. Truth: you can change your tax election later, but it requires filing specific forms with the IRS, and should be done with careful planning and professional guidance. Section 8. A simple rule of thumb and a checklist for your choice. Deciding between a default LLC and an S-Corp can feel overwhelming, but you can simplify the decision by using a general rule of thumb based on your business profit. Remember, these are just guidelines to give you a starting point. Your personal situation will play a role. State laws will play a role. The nature of your business will play a role. Always use these rules as a way to frame your conversation with a tax professional, not as a final answer. Here is a simple rule of thumb by profit level. Profit under $50,000 per year. The default LLC is usually the best choice. The extra costs and administrative burden of an S-Corp will likely erase any potential tax savings. Profit between $75,000 and $120,000 per year. This is the zone where an S-Corp often starts to make sense. The tax savings on distributions can begin to significantly outweigh the annual costs. Profit over $150,000 per year. The S-Corp election is very likely to provide substantial tax savings, making it the preferred choice for most owners who can document a reasonable salary. To help you think through the decision more deeply, here is a simple checklist. Is your business profit consistently above $70,000 per year? And do you expect it to stay there or grow? Can you clearly determine and document a reasonable salary for the work you perform? Section 9. Your next steps: how to make a smart decision. You have learned about the myths, the math, and the real-world costs. Now it is time to turn this knowledge into action. The first step is to get a clear picture of your business's finances. You need to create a realistic projection of your net profit for the next year. Do not just guess. Look at your past performance and your future prospects. Will your profit be closer to $40,000? $140,000? A solid profit estimate is the foundation for making an accurate decision. Your second step is to research what a reasonable salary would be for your position. Look at job posting websites like LinkedIn or Glassdoor for similar roles in your geographic area. What would a company have to pay someone else to do what you do for your business? Document your findings. This research is not just for your own calculations, it is crucial evidence you would need if the IRS ever questioned your salary. The third and most critical step is to schedule a consultation with a qualified tax professional, such as a certified public accountant. Do not rely on advice from friends or general articles online for your final decision. Your business is unique. A professional can take your specific profit projections, your reasonable salary research, and your state's laws to run a precise side-by-side comparison. They can give you a personalized report. This guide is meant to make you an educated client, not to replace professional advice. Taking these concrete steps will move you from confusion to confidence, ensuring you make a decision that saves you money and gives you peace of mind for the years ahead.